Good afternoon, everyone. In today's video, I'll lay out my bearish bias inside the S&P 500, starting off first with the weekly time frame chart and then moving down to the daily time frame and then intraday time frames as well. I'll also lay out two specific options contracts that look interesting in terms of those of you looking to try and participate in the bearish move as well. Now, starting first with the weekly time frame chart here, the market pulse is where most of our bias stems from. It's currently in a stage of deceleration and has been ever since March of 2022 when this line turned red. Currently, that line is red and price is pulling back to the market pulse, suggesting if anything, this is a pullback in an overall downward trend. We can see that with this trend line as well, and we're looking for really new lows in this next leg down lower. Now, in terms of where this upper edge of the zone overlapping with our trend line is, for that we can use previous support. And if we extrapolate that out, we really get a zone between where price is currently trading to 420. So between there, we think price is likely to really chop around sideways. But once we break this direction and we're looking for it to break to the bearish side, we're looking for those new lows even below 360. Now that's our overall bias off of the weekly time frame chart. If we move on to the daily time frame chart next, one other thing that I can do is layer on our Fibonacci levels. These are the retracement levels we've drawn using February 2020's high and March 2020's low. That's given us a roadmap that price has been following ever since. Using that roadmap, most recently price has fallen to the 1272. Now pulling back to the 1618, we expect this area to again act as resistance. And once we break that, assume this move actually does pan out rather, the next Fibonacci level we have is 340, which would be our Feb 2020 lows. So that's our stretch target we're looking for on the downside. That's quite a ways from where price is currently trading at though, and something a little bit more realistic and nearby is that 400 price point. That 400 price point also overlaps, at least as of right now, pretty close to the market pulse line on the daily time frame chart. And if price does get to 420 and then show us signs of reversing, that would be the price that I'd be targeting. Now, in terms of those signs for reversals, that would be the edge signal confirmation, a red arrow suggesting that, hey, we expect price now to finally stall out and reverse, at the very least retreating back to the market pulse line for a reversion to the mean sort of trade. Now, we've already laid out the bearish case for a larger downside target. The question is now, how do we participate in that move in terms of pinpointing entries? For that, we can use intraday time frame charts here. What I'm looking for, at least on the SPY ETF here, that's SPY, is for price to get to the upper edge of our volatility box zones, and bonus points if this happens to overlap with the 420 price mark that we had as the upper edge of the resistance. So if we get price overlapping over the next few days with a rally into 420, and that's also in the upper clouds, that would be the perfect time, in my opinion, to buy some of those 400 puts, which in August expiry is currently trading about 114,000 contracts, and in September's expiry is currently trading a little bit less, 78,000 contracts, but still a lot more in terms of liquidity compared to the rest of the options chain. So that's for those of you that would like to directly buy premium. One other idea that I'll call out before we move on to the ES futures is the last time we had price pull back to this trend line, we set up a butterfly that was right here, and that butterfly paid out really nicely. One of the learning lessons we had from that was, in fact, using a put would have been more lucrative given the downward pressure we ended up seeing, but the butterfly was a cost-effective way to set up that trade. So I'll leave a link to the video in which we did the overall trade setup there, and we spent more time crafting the butterfly, which you might find useful if you are looking to employ a similar idea this time. Now, I've laid out already the puts in this case, which would be the 400 puts. Now, finally, the last thing we can do is talk about the same levels on the ES futures, and that would be the 4,200 mark. And for the intraday levels coming into our ES futures, using something like the scalper models, for these upper edge of the clouds to overlap with the 4,200 would be where we would consider the bonus points, either for setting up something using the ES options or still setting up the SPY options trade, just using the ES futures as your compass to navigate this trade. So again, one more time to recap what we discussed. The weekly time frame chart here gives us our bearish bias. We're looking for this to be just a pullback to the market pulse and for this trend to continue. Our most stretched downward target that we have as of right now is 340, and that's really stemming from the SPY using the Fibonacci levels. 340 would be February's high. If we do see that downward move pan out, better ways to play it for near-term levels, that 400 price point, really using something like the 400 puts, or crafting a butterfly, an unbalanced butterfly with no downside risk if we do overshoot below 400 to the downside. Alright, I hope you found this video to be helpful for those of you looking to craft any sort of options ideas on the S&P 500. Take care everyone, good luck trading, and we'll see you in the next update.